Alright guys, welcome back to another video. In this one we're going to be doing the weekly recap from a macros perspective, what I'm looking for on the week, how that's going to frame any trades that I'm thinking of taking, along with my weekly options positioning. I told you guys I would be wrapping those into one video every Monday where I break down what's going on in the markets this week, how that's going to affect gold and other assets that I like to trade, along with all the trades that I've taken today on my options positions. And again, hope you guys had a good holiday and some well-deserved time away from the charts. Let's go over the week ahead, both from a trading perspective and how I'm positioned on the option side. Again, I want to be very clear up front. This week is not about active trades for me. I'm not taking any swing trades until the start of 2026. I did see this trade forming right here with a macro bias on gold for shorts. Unfortunately, we did get one touch, two touch, three touch, and we didn't unfortunately, we didn't have the break and the retest, which is what I need to confirm that market structure bias as well as the macro bias. This was a great area of interest. I believe we also had some Asia lows right here, and we had some low volume right here, so I do think gold would react off here and maybe continue downwards. I wasn't very committed to this trade, so I'm not very versed in what's happening right now specifically. More so, I'm just taking a good account into everything that's going on in the world. And I did see this from a market structure standpoint, showing me that we could go short here. And, there was no break and retest. It was just kind of a crash through. So that's it. We're not really looking at anything over here, and I don't really care to be taking any trades until next year. So again, everything we're going to talk about in this video on the macro side is going to be strictly context. There's going to be no execution. It's about understanding what's happening right now, not forcing trades in a low liquidity environment. So we'll start with the trading outlook on the week. We'll walk through the economic calendar and how this could affect gold and then other assets that I do like trading. I'll break down exactly how I'm positioned with options this week as well later in this video if you guys want to see the trades that I'm currently in. But again, this is a classic year-end New Year's transition week. We do have some data going on here, but the participation is going to be very, very thin, and the liquidity is going to fall off very quickly, especially as we head into January 1st, which is going to be a bank holiday. This means that moves can be a little bit exaggerated, follow through could be very unreliable, and good setups can turn very random very quickly. So again, for me this week, just like last week, this is not a week to be aggressive. This is more sit on my hands. If I see something clean, I can note it, but I'm not acting on it until volume and participation return in 2026. So first up today being Monday, we did have pending home sales that did come in a little bit better than expected. We were forecast with 1%, came in at 3.3, with the previous being 2.4. We also had crude oil inventories and natural gas storage, but housing data like pending home sales gives us a good read on demand and rate sensitivity. But this late in the year, it's more of background noise than any kind of trade driver for me. Also, energy inventory can move oil short term, but it doesn't really meaningfully change my gold bias. And with me not taking any trades, this is more like, okay, I'm acknowledging it, I understand it, but it's not helping me frame a trade right now. So for the gold impact on this is going to be very minimal. This is just context only. Tuesday, on the other hand, we actually do have the big bad FOMC. This is something that I will be taking into account very heavily. We also have Chicago PMI, and the HPI, but this one event for me is what actually matters the most. The FOMC minutes will ultimately tell us how unified the Fed is right now, how concerned they are about growth, and how close they are to shifting any policies. So if the tone is cautious and growth concerned, or they're leaning on the dovish rates, that's very supportive for gold. But again, I'm not trading this reaction. I'm just using it to frame my bias going into 2026. With FOMC being very important, I would argue for me personally, I do pay a lot more attention to unemployment claims. This is a good kind of headwind that I like seeing, but this is really what would drive me to get really excited on the charts, being the unemployment claims. We do also have crude oil inventories again and natural gas inventories, or storage, but nothing too crazy over there because I don't really plan on trading crude oil or gas or anything like that. I'm more focused on gold right now and indices. Unemployment claims are very important because they feed directly into the labor market narrative. A weakening labor market supports rate cuts, it weakens the yields, and is very constructive for gold. If the claims remain very tight, that dampens the tailwind on gold. Either way, the data will help me kind of weight the macro scale, not so much press trades. As you can see from the previous, we were sitting at 214,000. We are looking for a bump up with 215,000. So I do foresee if we do have a good beat on it, that could affect gold more so. If I was looking for longs, I would look for a miss on the forecast especially, and that would tell me a lot about how the economy is doing from an unemployment claim standpoint. Thursday, bank holiday. Liquidity is effectively gone. Everybody's going to be hungover. I don't think anybody's going to be in the markets that day at all. If you are trading a bank holiday, I seriously urge you to just sit on your hands, lock your account, throw your computer out the window. Do not be trading on bank holidays. It's just not worth it. And then Friday and Saturday, we do have some little yellow folders about manufacturing PMI and some other FOMC speakers. Again, it's more commentary and confirmation, not action. Nothing here changes my execution plan. So how do we look over this week as a whole, and how does this frame a gold trade? So when I look at this week as a whole, FOMC minutes can add weight to gold. Unemployment claims will reinforce that or push it back. Everything else is a little bit secondary. Looking at the charts right now, we are very bearish as we, did test these all-time highs, which was really cool. And, unfortunately, we did close this trade pretty early compared to what we could have held for. But again, this is a very targeted TP. So this would have been a completely separate trade, which we did miss by a couple points right here, as I talked about in a few previous videos. But, we did have that good run. It's time for a correction. I will say it is one of those things where we do need to have a low like this before you continue higher, make some structure, continue to the upside. Or this could be one of those situations where we put in this high and then we are having a good retrace with a lower high and following with a lower low and continuing to the downside. So this data is going to be pretty important to me just to kind of understand, and then that'll help me frame a trade in the new year with the upcoming data that we'll obviously have going into the new year. If the macro continues to line up, that's something I would want early in 2026, but right now I'm not forcing a trade. I'm way too relaxed and enjoying my kind of time off right now from the markets to, put that load on myself to, actually be in the markets and, actively trading currently. Again, low liquidity and major macro is kind of just observation mode for me. It's nothing to get involved in. And this is the exact type of week where good traders will sit on their hands. Even if macro points in the right direction, stops can get run, levels could get ignored. Randomness kind of just dominates the markets right now. So I'm intentionally staying flat on the swings and, preparation now, and we'll execute later. So options is where I'm very active right now still, just because we're in these low volume weeks. That means I can get a little bit more aggressive with the cash secured puts that I'm playing. So we can talk about some of the cash secured puts that I've made for this week, and then we can roll into some of the covered calls and how I'm managing some of the other positions that I currently have. So with SanDisk in particular, we're just re-upping this with another cash secured put. I liked where it was last week. It expired worthless, meaning I didn't have to buy any of the shares. So this week, again, I just ran it back and sold another cash secured put. I do like where it's at now, and I'm comfortable continuing to sell puts at these levels. We are in between two good support levels right now, and we can measure it right now, actually. We are 6% away from our strike price, meaning I would pick up SanDisk at a 6% discount from where it's currently trading at. So again, either I'm winning on the premium side or I'm winning on owning SanDisk at a discount. Now, IREN is where it does get very interesting. This is a stock I'm very passionate about. You guys can obviously do your own research on it, but I sold another 2 cash secured puts on IREN. I actually already have 300 shares of this stock, and what I'm doing now is intentional scaling. I want to lower my cost basis on this because I see a lot of room for growth heading into 2026. So one of two things is going to happen. Either IREN is just going to expire worthless way above my strike price, or we're going to have a dump, we're going to get assigned, and then I have all this upside where I've actually dollar cost averaged down, because I believe my cost basis is around here, around the $48 to $50 mark. So we are trading considerably lower than where we were before. So there is a lot of room to the upside on this that I do like and I would like to be a part of. So what I'm doing is, all I'm doing here is giving myself the ability to dollar cost average by buying more shares at a lower price and then bringing my cost average down from here, maybe to around here. And then I have a lot more upside to play with when I decide to sell calls and ultimately unload the stock. Now, the next one is another re-up. We're going back to Robinhood. I just do like where it's trading right now. Volatility is pretty reasonable and I'm comfortable owning it at the strike that we have right here. We do have pretty low volume again, so with this cash secured put position, I would be holding it a lot lower from obviously the trading highs. If I go check from the highs, we are currently 26% away from the all-time highs that Robinhood was trading at. So I'm not too bummed out owning it down here at a discount. Obviously, for it to get there, we would have to drop around 3% to get assigned on these shares. But with this week being very low volume and having a bank holiday this week, I do think this could expire worthless and I won't even get tied up in owning the stock. All right, now the interesting pick and the ballsy pick that I had this week. This is a higher risk but more controlled size trade on Rocket Lab. This is a bit of a riskier one for me, and that being said, I did say I was going to start getting out of my comfort zone and playing with stocks that have different kinds of volatility and lower caps. And Rocket Lab is a very, very interesting one for sure. That being said, we're a good number of standard deviations away from current price, which gives me a good buffer that I am comfortable with owning the stock at. So from current price, we would be almost 7% away from opening this morning. From that high, we would be a 10% discount from where it was trading. So again, this is higher risk, but more controlled size with really good premiums on it. So that's very nice for me to have. Now on the covered call side of things, this is interesting because I did have another IREN covered call that I was going to sell at, I believe, $52, but unfortunately we're just not even getting filled on it because there's just no volatility around here right now. The stock is trading a lot lower, so it is one of those things where I'm just waiting for good premiums. They're just kind of being sold for pennies right now, so there's not even a point in running covered calls. This week is more focused on the cash secured put side of things to average into the position that I have here. The next covered call that we're selling is actually Palantir. Palantir did have a big sell-off, unfortunately, back to where my cost basis is where I own the shares. I own 100 shares at around $184.50. I was looking to sell a cash secured put at 200. We did get filled on that. Right now I'm just waiting for good premiums. We didn't make too much on this trade because we are considerably far away from it, but since we are in the money, meaning the shares are here, but it was trading in this area, meaning above. So right now I would be winning on share price, but obviously you can see we're kind of at like the break even of the shares. Obviously I'm bullish on the stock in the long run, so this isn't really an issue for me to hold this going into 2026. Once we do build higher, I'm going to find a level that I'm happy selling at, and that will yield us a really good return, considering if I sold it maybe next week, another cash secured put at around $200, where our current shares are, I would have almost an 8-ish% gain on the shares, and I would be selling in the money for a really good premium that would make up a lot more, or probably equal to that share price gain. Most of the upside here is just the stock appreciation plus that solid premium that will net later. And finally, we have Dell. This one is a little bit interesting because it's been very, very slow recently. There's no stress here. I am comfortable owning it where I own it at right now, but it is just better for covered call opportunities to wait so I can get a good exit price on this. So I was looking to sell a position at $144 a share. Currently the share price I own it at is around $136, and we are trading at $127. So we do have a lot of ground to make up on Dell, but personally this is a very comfortable spot for me to own it at. As you can see, we do have a lot of resistance right here. We're looking at being around where we were in June, so obviously I do want to see the stock push higher in 2026 and show me some love and get me out of this position. It's not one of those things where I'm trying to get aggressive and offload it. It's just where I've been so tied up in this stock now for a couple of weeks where I am very much ready to sell it just so I can start playing other stocks and diversify a little bit more and not be so tech heavy. I just do want to get rid of Dell so I can play other stocks. I would even sell it for a bit of a loss if I managed to get some good premiums on it, if they were in the money covered calls, and just offload the shares, get a good premium, and then I can make more money, obviously selling with the money that I have tied up in Dell right now. So just a quick recap, with New Year's coming up, volume will die down sharply before and after. So this actually increases the odds that prices will stay very range bound and options will expire worthless. So premiums should get collected very cleanly. And this is why this week is about controlled positioning and not getting aggressive. To summarize everything we went over in this video, macro data is just context this week. It's not for trades. There's going to be no swing trading until 2026. Gold bias is still being built but not acted on. Options are diversified this week across some different names. Cash secured puts are my focus this week. We're kind of ignoring the covered calls with the bad premiums that we would get with them, or even the lack of premiums. And low volatility does favor the patience around here. So this is just about ending the year clean. We're so close to the finish line here, and I don't really want to make any risky moves right at the end of the year that's going to put a bad taste in my mouth for 2026. There's nothing wrong with slowing down. Knowing when to not push on the gas is one of the most important skills to have when you're trading. I'll keep watching the data, preparing my bias, and letting the options kind of do the brunt work of the consistent gains. But the real opportunities are going to come back when the volume comes back in 2026, and I will be ready for that. If you guys found value in this video, make sure to leave a like, subscribe, ask any questions you have in the comment section. And with that, we'll see you guys in the next one.